Jaisri and Aditya, warm welcome to both of you. Thank you for being here with us. Jaisri is a director in the deal tax practice at Big Four. She has 15 years experience in this field. Her expertise include diligences, transaction structuring, planning entry strategy into India, and also she has worked with across many jurisdictions like UK, US, Australia, Singapore, Netherlands, and so on. So she is a qualified chartered accountant and holds a degree of a bachelor's degree in commerce also. It's a pleasure to have Jaisri with us, and she'll be taking us through on the tax matters. Aditya is a partner in PwC India deal practice and specializes in M&A tax. He has around 2 decades of professional experience in the tax and regulatory structuring and consulting advisory to multinationals. He has gained vast experience in conceptualizing, strategizing, evaluating, structuring, and implementing various M&A transactions, cross-border restructuring, foreign investments, and so on. He was also seconded to PwC Malaysia as part of the ITS and M&A tax team in Malaysia for 2 years. He's worked in local tax and regulatory structure and consulting in the areas of ITES, media sector, and also other domains. He leads the Japan's business desk for South of India in PwC. So it's a privilege to have Aditya with us. Aditya, thank you for being here. Welcome to you. Before I hand over the dais to them, I have small announcements. One is that there is a mega conference coming up for the students. It's called Nava Yuga. I request all of you to send your articles. This is on 20th and 21st. The details are there. So please do encourage your articles to register for this. Thank you. Over to you, Jaisri and Aditya.
Hi, good afternoon, everyone. So Rahul has given us a very difficult task. First of all, post-lunch session is the most difficult session to keep the audience engaged. And on top of that, we have the tax. So we'll try to, make sure that you are engaged with us, and so that we have the question answers going. So as today's topic says, we will be covering the tax implications in a typical M&A transactions, and at least what I've seen is in earlier days, in a transaction like M&A, acquisitions, divestiture, tax used to be considered, but it never happened. It so happened that it is a deal breaker or a showstopper in any case, right? Like we have never heard a tax, because of the tax matter, the deal fell through, like many years back. Now what has happened is tax is a must, kind of an evaluation or a due diligence. No one can have a comfort without a tax due diligence. As in the previous session, we covered the tax due diligence, or the due diligence part, where the importance of the tax due diligence was highlighted. So what has happened, over the years is that there are a lot of changes which have happened in the tax laws, and because of which, and India being India, the tax laws, we all know it's not so simple in any of the deal transaction. How many of us here know the Vodafone case? Can anyone briefly tell me what has happened, what happened in the Vodafone case? No, not you, Rahul. Anyone? Sorry, I think Mike. Just take a shot, yeah.
Basically, Vodafone was held, or the erstwhile name was Hutch. So Hutch was held through various structures, and one share was held in Cayman Islands, which Vodafone acquired. So the tax department wanted to tax the transaction, saying that the underlying asset is in India, and it went all the way to Supreme Court, where Supreme Court ruled in favor of the SEC, saying that you are not liable to pay tax in India. Post which there was amendment in section 9, which says you should have significant interest in India, then you are liable to pay capital gains tax.
Absolutely fine, right? Okay. Now, if you just go deeper into this fact, Vodafone was never the seller, right? It was a buyer. Okay. Typically, very logically, capital gains arises in the hands of the buyer, not the on the seller, not in the hands of the buyer. But in India, the tax law, what it says is the obligation to withhold the tax is on the buyer, right? And this concept is very, very important in a deal scenario, because most of the time what happens is the buyer doesn't know that he has to withhold the tax, okay? And now the Vodafone case, everyone knows what happened in the Vodafone case. They still get the nightmares of the Vodafone. So that is what the criticality comes in, where you are in a non-resident buyer who doesn't know what is the law of India, and suddenly you tell them that, okay, now you did not withhold the tax and hence I'll come after you, the tax authorities. Whereas the seller who actually realized the money, who has to pay the capital gains tax, is not kind of in the tax net. So this is one of the kind of a unique thing which most of the buyers or in a deal scenario may not be aware of, because typically in most of the countries what you say is withholding tax is on the normal payments, right? Like you pay salary or pay any royalty, FTS, those kind of transactions, yes, you have withholding tax. But if it is a capital gains tax, you hardly have few countries who impose capital gains tax, withholding tax on the capital gains, and the obligation is on the buyer, right? Similarly, we have, now what has happened, why tax has become so relevant in a deal scenario is, now if you look at the evolution of the tax law, now we have general anti-avoidance rules, right? Yes, it came few years back, but few years, I mean, since last couple of years, we've seen our clients getting notices from the tax department on the GAR provisions. Now, where it has reached is that it is just the fact-finding exercise. They have stopped at the fact-finding exercise, but the very next step would be they'll start asking the questions on why we should not, kind of impose tax in a GAR provision. So whenever in a deal transaction, now the GAR provisions have become really, really critical. So we do have to evaluate the GAR provisions in a typical deal scenario. So just, okay. So this is a typical deal life cycle, as Rahul also covered this aspect in the previous session. So what we do in a deal scenario is, whenever the deal is getting structured, it is very, very important to analyze the tax implications. So that's the first thing what we do in a typical deal kind of a scenario. It could be a sale of shares, it could be sale of business, it could be acquisition. And the most important part in a deal is that you cannot be, even if you are advising a buyer, you cannot be completely ignorant of the seller position, because you cannot advise a buyer only taking into account what is good for the buyer. Many a times that may not work for the seller, and you have to somewhere strike a balance where both buyer and the sellers are not kind of in a tax inefficient structure. So it is very, very critical we take into account both sides of the story and then give the advice to the buyer, because most of the time the seller will come back and say that, okay, this is fine for the buyer, but it does not work for the seller, right? Then comes the tax due diligence part, very, very critical part, and the importance of the due diligence was highlighted. Many a times these the findings of the tax due diligence may impact the valuation eventually, because some of the adjustments what we do in the tax due diligence or the findings of the tax due diligence goes into the valuation adjustments, and hence it will impact the overall valuation. It is very critical that we cover the findings of the tax due diligence in the transaction document, be it a share purchase agreement, share subscription agreement, or whatever is the transaction document, JV agreement. It is very critical that we capture some of the critical aspects. We will cover that later, but there are certain aspects which have to come in the transaction documents, and hence the tax due diligence becomes very, very critical, and it includes both direct as well as the indirect tax due diligence. Then is the, once we kind of cross that hurdle, then we get into the tax structuring. So once after the due diligence, the exact facts of the target entity, the fact pattern of your client, maybe a buyer or the seller, and then you get into an actual kind of a structuring exercise wherein you evaluate whether it could be a lot of times what has happened in our experience, what we've seen is a deal initially could be a share purchase deal, which after the due diligence turned out to be a business purchase, just because of the findings in the due diligence exercise. So after the due diligence exercise also, a lot of thinking goes in the structuring as to what is the best way for a particular deal. And last is the documentation. As I mentioned, we do a lot of analysis and we do a lot of review of the transaction documents, because that is the most critical document which will stay forever, and that becomes a document which is a kind of a evidence between the two parties, especially if it is a third party transaction. Many a times we have seen, if there is a dispute, this document becomes very critical in the court of law, and hence it is very, very important to go through all the clauses, though today we will only kind of highlight the clauses or speak about the clauses which are tax related. But having said that, these are heavily reviewed by the legal counsels on both the sides, the advisors on both the sides, before the principals actually sign the document. So what are the clauses which we normally see in the transaction documents? First and foremost, your withholding tax. Okay, now people are still grappling with the withholding tax provisions. Now we have the TCS, right? That is on the seller actually. So the seller will collect, depending on the position of the buyer, he has to collect the tax from the buyer and then deposit that tax with the government authorities or the tax authorities in India. Right now, the thing is, you cannot have both withholding tax and the TCS together. If the transaction is subject to withholding tax, there is no need for the TCS. But if the transaction is not subject to withholding tax, then we go to the TCS provisions, which is basically the seller will collect 1% or 0.1% depending on the facts of the case, and that amount will be, again, the buyer can claim this amount as a refund once they file the return with the income tax authorities in India. Now this also becomes very critical, because a lot of buyers may not know, and if your consideration amount is substantial, that 1% or 0.1% also could change a lot of things. So it is good to evaluate these provisions in advance and tell, if you are advising the buyer or the seller, that this could arise, and keep that in mind, because moving of that much funds may not be an easy task if the transaction value is very high. Okay. The second part is typically what we see in the documentation is your the reps and warranties. Lot of reps and warranties comes out of the due diligence exercise. So as soon as we find out, or as soon as we finish our due diligence exercise, typically there would be list of items which will go as reps. Basically the target entity or the promoter may say that, okay, these are the reps and warranties which we are providing. Say for example, my income tax return status, I have filed everything in time, on time, I have not claimed any deduction which is not as per the law, all those reps, because that is very critical for the buyer, because tomorrow if something goes wrong, see, in a due diligence, if it is a 10-15 year company, you cannot go beyond 3-4 years, right? What has happened beyond 4 years, for that we need some kind of reps, and if the if the company or the promoters, if they are willing to give those reps, it is, I mean, typically we will negotiate for those reps in a deal transaction, in a deal scenarios. Similarly, you have certain CPs, right? Some of the due diligence findings, that is condition precedents, which can be, some of the findings can be rectified before you close the deal. So how it happens is, you sign the deal, then your CPs will kick in. Some of the CPs, like many a times, okay, GST returns have not been filed, or the income tax demands have not been paid. So those kind of things will go as a part of the CP. Once you finish I mean, I'm just talking about the tax, there are multiple other CPs from a commercial, from a financial due diligence perspective. All those will be satisfied, and then the final payment happens to the seller. So some of the things gets covered in the CPs, and some of the things gets covered in the reps. So what happens if the reps are wrong, or if it is, if it is not a right rep, then you claim for the indemnity, right? Then comes the 281 certificates, right? Now, as we all know, there is a provision under the Income Tax Act, Section 281, which says that you cannot sell the asset. There is a specific definition of the assets, or the property, what is covered in that property. You cannot sell it without the consent of the income tax officer. Okay. Now, technically speaking, any transaction, if you are selling shares, you need to go to the income tax officer, take an NOC, and then you can sell the shares, technically speaking. But given the time frame, okay, whatever 2 months, 3 months, what we have in a deal kind of a scenario, it is practically impossible to get that 281 certificate from the income tax department. So what do? We typically take a kind of a memo from any chartered accountant and saying that these are the things which are there for the particular seller, and this is obtained for the seller. Just to clarify, if I am a seller, I need to give that 281 because I am selling certain assets which could be questioned by the income tax authorities in the future, right? So I need to give that 281 saying that these are the tax demands, these are the outstanding demands, or these are the notices which are there, based on which the buyer will take a call and may ask you to rectify few things, or he may take it and keep it in his file and take it as a representation in his reps and warranties, right? Sorry, any question at this stage? We are at a high level, but we'll get into the deeper thing later. But any question on a very yes, 81. It's yes, good, yeah, actually good point. So earlier there was nothing, but nowadays in a transaction people are asking for GST also. The section is 81 actually, so it's easy to remember actually. So 281 and 81. So these are the certain things which we evaluate in a transaction, though we are focusing on the tax law. But when we evaluate a transaction, we will be evaluating stamp duty, accounting. I mean, typically it will be foreign exchange related transactions. So you will have exchange control regulations. If it is a listed entity, then SEBI rules, then the Companies Act, then the sector specific guidelines, and certain relating foreign direct investment regulations. So what happens is, I mean, this is again a deal in a deal scenario. The buyer or the seller would expect you to know just not tax, but everything, right? Relating to the deal. You don't have to deal with entire GST law or something, but anything relating to the deal, the buyer will expect you to advise him. So you cannot be saying that, okay, I will just advise you from an income tax perspective. That is not the expectation. Even if it is not said in so many words, the expectation is you cover everything, whatever is there on that slide, everything has to be covered. So if you give an advice and say it does not work from an accounting perspective, that may not work for a client. Whether it is a buyer or the seller, it doesn't matter, but it will not work from a deal perspective. So hence, you have to be kind of, and it's a very challenging and interesting thing for all of us, because beyond a point, maybe tax becomes little monotonous, right? Then you have other things, Companies Act, whether it will work in a Companies Act scenario, whether it is okay in a kind of if it is a listed entity, is it okay from a SEBI perspective? So it's very interesting to kind of cover all these things, but at the same time, you have to be kind of be regularly updated in all these aspects, because if you miss something, yes, maybe you are good at the tax, but if you miss something else from say accounting or stamp duty, again it's a very state subjective matter, right? State subject. So unfortunately, we are expected to know at least a very broad level what are the stamp duty implication in a deal scenario. So that's good thing, at the same time very challenging. Yeah. So from a tax perspective, what do we normally see in a deal is definitely income tax, whatever law in terms of the withholding tax, or the another critical aspect is your carry forward of losses, right? Lot of times, I mean, just keep this in mind that carry forward of losses or unabsorbed depreciation carries a value in the valuation. Whatever said and done, that is unless and until we are sure that it is not going to be carried forward, it carries a value which will be factored in the valuation. If your deal structure is such that you are going to lose that value or lose those unabsorbed losses, there could be an implication on the deal valuation. So it is very critical to know your company, if it has a carry forward of brought forward losses, how do we protect that losses so that you get the value if you are on the seller side, at the same time buyer gets the advantage of those losses. The other things from a tax perspective is definitely the capital gains tax. How do we structure both from the buyer and the seller side? So just to give you a simple example, right? If you buy shares, the consideration directly goes to the seller, and whatever is the tax, if it is individual, it may go up to 35%. If it is a company, depending on the long term or the short term, it may be 12.5 or it may be 20%. But as against that, if you buy a business, right, now buying a business will also have a tax implication because it is a business sale. It could be 20% or it could be more, but the money or the consideration goes to the company, right? But that is not the end of it, right? Like typically, if I am a owner of a business and I'm selling the business, I would need the cash in my hand, not in the, okay, fine, it is in my company, but a very good scenario is I have it in my hand. So when you want to repatriate, when it is a business sale, the money goes to the company, then there is an additional tax cost of repatriation from the company in the individual promoter or whoever it is. So that also may not be very efficient from a seller perspective, though buyer will say that, yes, I don't want to buy your company because it has a lot of baggage or whatever, but that may not work from a seller perspective. That's why we are saying that whenever you are advising, you have to keep in mind from both the seller and the buyer's perspective. Again, the tax, the next point is the tax litigation, very, very critical. So we were working on a deal wherein, there were a lot of transfer pricing litigations going on. So we came to a stage where the buyer had to, or rather seller had to give 100 million euros of indemnity cap just because of the TP litigation. So it is very critical that we know what are the litigations. I'm talking from a buyer perspective. When you are buying a company, you have to be aware of what is going on in that company from a tax litigation perspective. What are the probability? And these are all highlighted in the due diligence. When we do the tax due diligence, we do highlight, we do analyze the litigations, what are the probability, what is the risk matrix, everything will be highlighted. But having said that, what is that implication in your ultimate deal is that either it could reduce your value or you will have a higher indemnity liability from a seller perspective. But nonetheless, it is very critical to see what are the things which is, which will be carried on by the company once you buy the shares of the company, tax litigations. GST, most of the people are worried about the GST credit passing on. Relatively, the law is very clear now. You need to file certain forms to get the credit. But having said that, we haven't seen any challenges so far where in a transaction GST credit has been, some authorities have challenged the GST credit. The question typically comes is that, as we all know, slump sale. I mean, we'll cover what is slump sale later. Slump sale of a business is not subject to GST, and most of the time we will try to structure the deal in such a way that it is not subject to GST, just because the buyer may be able to take the credit. It is just a cash flow issue. But having said that, it's relatively simpler now to take the credit and take some of these positions. Repatriation cost, as I mentioned, that's very, very critical in any transaction, because what happens is there are 3 stages, right? One is investment, second is repatriation, and the third is the exit. These 3 are very critical whenever you evaluate. Initial investment, yes, you will be knowing what is happening because that is current. The client also asks, how do I get the money on a regular basis? Okay. For that, what do we do? There are different funding instruments. Equity may not be very efficient. You have CCPS, that is, compulsorily convertible preference shares. You have CCDs. You may have OCDs, optionally convertible debentures, or NCDs. So depending on the need of the buyer, how he wants to repatriate, we can use different instruments. Now, yes, that is possible, but what are the tax implications? So each instrument has its own tax implication. but that is one way to address the repatriation problem of the client. Second is the jurisdiction. If it is a foreign country from where they are trying to infuse the funds, we can evaluate multiple jurisdictions from where they can invest. Right now, I mean, if we look at the tax treaties, today we saw even Switzerland has withdrawn the multi MFN clause, most favored nation clause, though it is not affecting the transaction, but yes, the dividend rates are now again back to 10%. But having said that, now if you look at the treaty from a treaty perspective, except Netherlands, I don't think we have any country wherein we have a favorable tax treaty from a capital gains perspective. We used to have from Mauritius, we used to have from Singapore, but after 2017, both the treaties have been amended. So any investments happening after 2017 from Mauritius and Singapore will not enjoy the capital gains tax exemption. There is a grandfathering. If you have invested before 2017, yes, you will enjoy the exemption, but after 2017, you don't. The only country which has the capital gains tax exemption is the Netherlands. Again, that is also, say, a Dutch company holding Indian company shares, selling it to another company which is, or another individual who is not a resident of India, then only the capital gains tax is exempted. Otherwise, if the shares are sold to an Indian resident or an Indian company, then the capital gains tax will still kick in. So having said that, I mean, you cannot just blindly say that Netherlands, because there is this substance test also. Now, tax authorities have gone multi steps ahead in terms of they will not just give you the tax treaty benefit. They will question the structure. What is the substance, like Netherlands, if you are investing through Netherlands, what is it that you have in Netherlands? Is it just a shell company, or do you have operations, do you have people? All those questions will be asked at the time of the assessment. So it's easy to say yes, Netherlands is a good jurisdiction, but if you don't have substance, please don't try Netherlands, because then it is matter of time that tax authorities will come back and deny the treaty benefit, right? Yeah, I think, sorry, any questions so far? Okay, so technically speaking business, but then there is some level of comfort if you have an office, if you have people, you are maintaining or you are having regular board meetings, you are filing the returns, you are filing the accounts or getting audited, you have an office space, you are paying rent, all those things. Yes, there is a level of comfort, but if you have business, that's the best thing to have. So I mean, in a kind of, if you want the 100% kind of comfort, then you should have some business. Pure holding company again may not fly, but if you have these other things like the office, the directors, the local directors, all those things will kind of help you in kind of defending your case. But it's a thin line. Yeah.
Just to add to that, with this whole multilateral instruments coming into picture, right? There is something called a principal purpose test. So while the business and the directors, all of that is at a very basic level, more and more what tax authorities are looking at is, why are you really imposing a jurisdiction, right? Is it only for tax benefit? Are you really getting any other commercial or business reason in place to really have that jurisdiction? So that is becoming more and more a question.
Yeah, and if you have an existing structure, still okay. Yeah. But if you want to create a new, or you are creating a new structure, that definitely is a red flag. Moving on to the next slide. So these are the broadly in M&A, what we do. Either we buy business or we buy shares, right? I mean, either business acquisition or an entity which is share acquisition. Now, in business acquisition, as I was saying, there is business transfer, which is, as a whole undertaking, which is normally in the tax parlance we call it as slump sale, or you have a itemized sale, like you cherry pick the assets and liabilities and you transfer. But still, it is a business transfer, but the mode of transfer will be different. The documentation will be different. The tax implications will be different between these two. And you have a demerger. We are still talking about the business, and you have a demerger. Now, just to give you a broad implications of slump sale, typically slump sale is subject to capital gains tax. Okay. Whether long term or short term depends on the period of holding of this business. If you hold the business, or if you had held this business for 36 months or more, then it becomes long term, but if it is not, then it becomes a short term. Now, why people prefer business sale as to be categorized as slump sale is one of the reasons is you don't have a GST liability on this. Okay. Now, again, it becomes why, because it's a cash flow issue for both buyer and the seller, so they prefer to be a slump sale. Again, it's very fact specific. We evaluate both itemized sale as well as slump sale. Depending on the tax implication, we may still lean towards itemized sale, but most of the time what we have seen is a business, sorry, oh, this is already covered. Sorry, Jaisri is going to cover that, I'm sorry. But typically we will, say that, why slump sale is because then there is something amortization. Like say for example, if you are paying consideration in excess of the net worth, then that can be amortized towards your intangible assets. So Jaisri will cover that in detail, what are the intangible assets and what has happened in the recent past regarding the goodwill. Then it is itemized sale. Many a times you may not want to have the entire business, right? And in a slump sale, one demerit I can say as a demerit is that your indirect tax liabilities can move to the buyer. Okay. Whereas direct tax liability still remains with the seller in a business slump sale kind of a scenario. Whereas in an itemized scenario, it is everything remains with the seller. You don't have to pass it on to the buyer, even the indirect tax liabilities or the whatever, even the credits as well, it will remain with the seller. Demerger, in a deal transaction, rarely we have seen demerger, and it's mainly because though it is the most tax efficient way of transferring the business, it is rarely used because it involves the NCLT or the RD approval. And we all know that the functioning of the NCLT is not very efficient, so it will never fit in our timeline. So typically nowadays I think we are seeing 8 to 9 months for an NCLT approval, right, which will never fly in a deal scenario. So though it is it's a very, very tax efficient, because demerger is tax neutral. You don't have to pay buyer, seller, the company, no one pays the tax in a demerger scenario, but it's never used because of this. And what happens is in case where we have seen demerger being used is the internal reorganization. See, if it is a group company wherein you are not under the time pressure, though yes there is a timeline, but it's not like a deal scenario where you have to kind of close the deal within so many days or months. So in those kind of scenarios, we have seen people going for the demerger to transfer the business from one company to the other company. And this is very, very relevant in a pre-IPO kind of a scenario. What we have seen in many cases, pre-IPO is again, it is within the company, right? It's within the group before you go for sale, for listing. So in those kind of scenarios, we have seen a lot of companies, adopting the demerger as a route for their segregation or consolidating some of the businesses. Coming to the entity acquisition, again, a merger not very commonly used because of the same reasons that it's NCLT or the RD driven process. Though absolutely tax neutral, we can achieve 100% tax efficiency in a merger scenario, but not used because of the timelines. And then the remaining is only the share transfer. So we will have the typical normal share transfer between the buyer and the seller. But there are a lot of things which goes in the share transfer, like you have like a stepwise acquisition. You have one more point what I missed in the documentation is the deferred consideration, right? Now can anyone tell me, like say if it's a typical scenario in a deal where if I am buying say $100 worth asset, I may not pay $100 today, I will pay $90, $10 I'll probably pay maybe 2 years, 1 year later. But do we know what is the tax treatment for this? See, if I'm a buyer and I'm paying say Rahul $100, but $90 I pay today and $10 I pay it maybe 2 years later. What is the tax implication? I am a buyer because I know that I need to withhold the tax. Do I withhold on 90 or do I withhold on 100? Any? Sorry, sir. Yeah. Yeah.
Tax.
Yeah.
If it is absolutely simply time framed, time bound payment, then
Yeah.
it will trigger on day one.
Yeah. So yeah, absolutely. So how we evaluate in those kind of scenario is it a deferred consideration or it is a contingent consideration? As sir rightly mentioned, if it is certain that okay, $10 will be paid after 2 years, okay, then it is certain. Then there is no question of not paying. So you have to withhold the tax on 100 today, okay. But if it is contingent on few things which may or may not happen, then we can take a position or we can take a call that yes, it can be the $10 can be subjected to tax later whenever I pay, and whether it is 10 or 5 depending on the conditions which will be met the future point in time. So let me stop here and I'll hand it over to Jaisri for each of these things and some of the nuances of the each of the modes of transaction. Sorry, I have a question. Sorry.
Nowadays, what is happening, like company is having a brand and it is doing only online sales. Okay, so in that case, other company acquires the brands.
Brands,
And
right? Brands.
Yeah, brand
Yeah,
only,
yeah.
acquires the brand only, and whatever stock is there, that only they will, the other company will acquire. So where this kind of acquisition will fall and what is the tax implication here?
Okay. And so this company, is it the business of them is only to do it has only brands and selling the goods, or what is the business of this company?
This the company
Yeah.
which is the brand of which is acquired, that like Soch is one of the brand. Okay, they are making sale. So another company will acquire this Soch brand.
Okay. Yeah. Okay.
And whatever items will be there, stock, they will acquire.
Only the stock.
And there will
right?
be agreement that okay, this the existing company will not make any further sell in the name of
Understood.
the same.
Non-compete and everything will be there.
Okay,
Yeah.
so
yeah.
where this will fall and
So
what is
this,
the tax
I think the
implication?
chances of this falling in the itemized sale is more, because unless you say that okay, along with Soch brands, I buy the assets, liabilities, everything as on particular day. Say there are certain sales would have happened, the debtors will be sitting, there are some creditors who are sitting only relating to this brand, okay, and then you have these employees of the particular business who are kind of helping in the brand or in the sale and purchase and all. Then it is a substantial thing to say that yes, this is a business which has transferred and it can fall under a slump sale. But if you are saying it is only the brand, okay, then it is it's like it's a weak argument to say it is a slump sale. It's most likely it will fall under the asset sale, because there is nothing else is going on going with the brand. It is just most of the time what we so I'll give you an example, sir. We have taken a case where only the employees were transferred and we still took a view that it is slump sale, because how it was structured is that globally the company was selling the some certain business. In India, that business was carried on only by this the employees, okay. Laptops were on lease. It was not pertaining to that particular business or the particular employee. The whatever outstanding relating to that employees, in the sense the whatever billing they had done, it was settled. The only thing which was left is employee liabilities like PF, the gratuity and all those things. So we transferred the employees and the liabilities, and we still said that it is a business, because after that the company did not have that business, and these were the technically qualified people to do that particular business, and they were moved to another company. But we still said that it is a business because it is structured as business worldwide. In India, it was only these employees who were doing this, and after they go out, this business will not be continued.
But
So-
here, what was the case? Like brand was acquired, then that brand was created by a partnership firm, and brand has been acquired by the company. Then that this firm which has created the brand, they were closed because they were having only one, that is the one brand.
Brand.
Yeah, contract only. The contract was that okay, they will acquire the brand, and then
So the larger point is that, maybe just moving to the next slide. So I think this is a good segue into what I was about to cover, which is what is an undertaking. You please take your seats. So in a slum sale, as per Income Tax Act, what it says is it's a transfer of undertaking to another entity for a lump sum consideration. So two important things here. One is it's an undertaking, which means that it is a group of assets and liabilities which are capable of being run as an independent business. Like Aditya mentioned, it can just be a set of assets. It can be a really large business which has everything under it. So in your case, for example, you're saying brands were moved, right? So if, let's say, along with the brands, all the related contracts, everything moved, and you were able to really call it a business, that's when it'll qualify as a slum sale. Yeah. Yeah. So it's not really so much in terms of, is it a really big asset? So it's not just the monetary criteria that will determine whether it's a business or not, right? So if it's a captive unit, for example, like Aditya was saying, employees are the major asset, right? I don't really need the laptops to run the business. I can always lease it out. So we've seen a lot of cases in captives, especially where employees, AR, AP, all of these together just move, and we've still called it a business. So therefore, in the case of a slum sale, it's very important what the undertaking is, and you're not really giving values to each and every asset and liability individually. So it's for a lump sum consideration. So
maybe just one more point. Sometimes what happens is it depends on the type of the companies. Like the service companies, it's easy to identify the assets. Even the employees are assets. But if it is a manufacturing or a trading kind of a company, then the analysis becomes slightly complicated. Like you'll have to really justify what is that business. Whereas in the service, it's like, okay, these are the set of employees who are servicing that contract. I'm selling it, so my business is kind of going out. It's easy to kind of justify. But trading and manufacturing, yes, we do have to do some kind of analysis as to whether it will fall under slum sale or an asset sale.
I'm not a tax expert, but the way I have understood it, if what is being sold as an undertaking, if it can operate on a standalone basis, if it can operate on a standalone basis and can run on a going, like we understand going concern concept, right? If it can operate on a standalone basis, is business transfer. If it is non-operable in the standalone basis and it requires additional assets, people, investments to be made for that business to start operating, it is an itemized sale. Typically, that is how I look at it. That's why when you see the conceptually, right, the spirit of it is, in slump sale, you don't need to list down the assets and liabilities that are going over, because the whole business is being transferred, which can run by itself, and it doesn't require a third party support or anything from the outside. But when you look at itemized sale, you're taking up select things and then you're infusing the balance of the things from your end, and hence it becomes an itemized sale. That's how I read it, to get a little bit of clarity at times, while I'm sure definitionally it is very different to be read. I just thought of sharing these thoughts.
Thanks, Rahul. So recently we had a case where, almost everything related to the business was moving. It was a training services business. So everything but the license to operate in India was not moving. So the license was a critical part, right? Without that license, you can't really run the business. So we did a lot of brainstorming with the client and finally came to a point that this will be more likely an itemized sale, because a very critical part of the business that is required to run it, like Rahul said, independently without really restarting things, was missing, right? So therefore, we actually treated it as an itemized sale. So why does this whole slum sale versus itemized sale become important? Because the way you tax it under Income Tax Act and GST is very different. So in case of a slum sale, like we've mentioned there, at the crux of it, everything is consideration less your cost, right? So here as well, it is sales consideration less the cost being the tax net worth. So it's different from the book net worth to the extent of your depreciable assets, right? So your WDV as per tax versus Companies Act. Now recently you have Rule 11 UAE which has come in, which says that the sale consideration, so earlier we didn't really have a definition for a sale consideration for slum sale. So now it is your fair value of the business undertaking or the actual consideration, whichever is higher. The fair value is again largely based on book values. So like Aditya mentioned, if the undertaking has been with the seller for more than 36 months, it's long term, otherwise short term, and accordingly the taxes will apply. Uh, Again here, the tax losses continue with the seller. Income tax liabilities continue with the seller. Indirect tax liabilities would move, okay? So again, 281 and 81 is something that has already been touched upon. So this again becomes very critical in a deal structure because if there is significant amount of litigation, there are times when chartered accountant certificates do not really, solve the problem. So you really would have to go to the tax authorities as well. So while I've talked about slump sale versus itemized sale, just giving you a flavor of slump sale versus demerger. So while demerger is again the NCLT route and it takes its time, etc. In case of a slump sale where you're doing a fair valuation, you get a cost step up. In demerger, that becomes very hazy because the idea is it's tax neutral. So nobody's really gaining by doing a demerger, right? In the sense that while I'll go there, I'll explain in a little more detail as to why a merger and demerger is typically treated as tax neutral. So cost step up is generally not available in a demerger, it's available in slump sale. So if a book value is 100 and I've paid 300 for that particular business, when the buyer is doing an allocation by way of a purchase price allocation, right? So what happens is the 300 gets bifurcated between the assets and liabilities that the buyer buys. So there you get a step up in cost. So something that the seller would have maybe accounted at 50, if the fair value is 100, then I get depreciation on 100, right? So that cost step up is available. Till a while back, goodwill was amortizable. You had the Smith Securities Supreme Court ruling which allowed depreciation on goodwill, but then the law got amended. So you no longer have depreciation available on goodwill. So now it's all the more critical that whatever you're buying, you bifurcate it properly and try and identify proper intangibles and not just bucket everything into goodwill. So that's an important thing. GST again, where you're transferring and undertaking on a going concern basis similar to the Income Tax Act, you don't have GST. And for the credits, you have a particular process that you follow and then GST credits move. GST again, there has been a recent debate in terms of what is going concern, etc. There has been some rulings around it, but at a very basic level, both income tax and GST align to say that it has to be an undertaking, undertaking meaning that it's a set of assets and liabilities where you're able to independently run the business. Yeah.
So just to add,
The undertaking held more than 36 months we have. What is the criteria for it? Like first sale invoice or CTO date or plant came into effect kind of thing. What is the criteria for defining the 36 months?
So typically it's when you started running the business. So maybe the first invoice could be one of the references that you will take.
yeah, so I think that also, like say for example, if it is a manufacturing setup, maybe when you set up the manufacturing, so you may start production maybe later, but if you have set up the manufacturing plant, we can take a view that yes, that is the date when you started the business.
When you bought your, plant and machinery. And
yeah, I mean some of these software as well, okay, inaugurated the plant and those kind of things, maybe that could be considered as a date of manufacturing. Yeah, that is for the merger. Yeah. No, so if that is the company, right? Like, but if it is a say business within the company, I don't think you file separate form for that.
So if you have 2-3 businesses, for example,
yeah,
then that wouldn't really
because
be
that will be the simpler thing to say that okay, whenever I file that commencement of business can be the date. But we are talking about the scenario where you have an existing company, you have multiple businesses, and you start one more business. What is the date of commencement of that business? So one thing, sorry, just to add for the amortization of the intangible asset, it's very critical in a deal scenario because that is one way the buyer recovers his cost, right? Like say for example, if I identify an intangible assets, not the goodwill, but which is amortizable under the tax, you get a tax break of 25%. Okay, if you extrapolate it, like if you have paid $100, maybe through this, okay, because if you have a huge intangible asset which is subject to 25% amortization, you can actually recover that $100 within a period of 5 years. So that is also, that's why it's very critical to see which are the intangible assets which we can identify, which is tax amortizable. Goodwill is not, so you need to be very careful when you are paying, excess over the net worth. We need to do that, kind of analysis like a know-how, trademark, brands, which customer, yeah, that's one, okay, customer. Yes. Yes. In the PPA, you should try to allocate as minimum as possible towards the goodwill.
So goodwill, so we used to call it goodwill versus goodwill simplicitor, which means goodwill which is backed by employees and customer contracts and all of that, and then there was a remainder which was just goodwill. So that differentiation is no longer there, so you actually need to call it that. And to your point on customer contracts, so there again there's a nuance in terms of customer relationships versus customer contracts. So customer relationships don't carry any value really. I mean, you can value it, but you're not going to get depreciation on it. As against that, if you have customer contracts where you're able to demonstrate clear cash flows, then that becomes a better situation to be in. It's not really a settled position. You're just better off than just having a list of people that you have.
A lot of senior counsels are not comfortable actually.
Yeah.
So we. No, it's not. No.
It's not. You're just better off. That's
Yeah.
all.
So I mean, we have gone to many senior counsels and then they were not comfortable, in taking that.
In a slum sale, how do you bifurcate? Because you are not supposed to give values to each item.
Yeah.
So the bifurcation is more in the buyer's hands. When you're looking at a lump sum consideration, you're looking at it from the seller's perspective. So the buyer will have to bifurcate it for an accounting, right? So like I said, if something worth 100 is being acquired for 300, the buyer will allocate the 300 against the assets and liabilities. So you will get a valuer to do that valuation.
So there is an exercise called purchase price
price
allocation. So they will do that actually. And the critical part would be to identify the intangible assets, because the tangible assets, they will just, whatever is the book value, unless it is land and building, they will just, kind of add those values. But yeah. So for example, if you have paid $100 for a company and you don't have the bifurcation of the assets, right? So out of $100, say maybe tangible assets, okay, which are like debtors, credit, debtors, cash, and all those things, say 40, right? Now 60, you don't know what have you paid for. What the valuers will do is that which are these 60? I mean, where like say you would have paid it for a trademark or a brand or a know-how, right? And not the entire 60. Maybe that. So that exercise the buyer will, the valuer will do. How much should go towards the, say, know-how or trademark, but there will be always what we have seen is there will be left out, some portion will be left out which will go to the goodwill. So that's how that purchase price will be.
So as a process, it's a exercise. I'll just very simplify it. You have a business that is being sold, but in accounting terms, what comes to you is only the balance sheet, right? The previous P&L is for sellers, and you're going to generate newer P&L from the business operations. What comes to you is a balance sheet. In a slum sale scenario, assuming there is a balance sheet that is recorded in seller's hand, now you're paying a price for it. At the end of the day, you're paying a price for the net assets of that particular business. Now, assuming the net asset was standing at 80 crores, but you're paid 100 crores. Now, when you take over the balance sheet, you have to start accounting for it. You have to take it into your balance sheet and consolidate it. Now that purchase price you paid is 100. Now you need to allocate that purchase price to assets and liabilities. That process is called purchase price allocation. Now in that process, you can change the valuations. For example, fixed assets. You went and did the valuation. You found that he had reported the assets at, say, out of 80 crores at 20 crores. You did actual valuation. It said that that machine is only worth 10 crores. So you obviously cannot value it at 20 crores because tomorrow that business, that particular asset will not last the worth of 20 crores for you as far as your cash flows are concerned. So you reduce the value. Similarly, for each of the assets and liabilities, as part of your opening balance sheet, entry, you'll do this exercise, which is typically done by an expert valuation, who's a valuer, And that is where whatever is the balance left over will come as goodwill, or if it is, if you're paid less than the price of actual assets and liabilities, it will come as capital reserve, vice versa. But the point is, in slum sale, typically it's a business that you're buying, so you need to do the allocation. In an itemized sale, when you're selling itself, it is known as to what price you're paying for each of the components.
So maybe this case study will make it a little clear. Sorry, we're running out of time. Maybe
No,
after
I
the
think-
session, can we
No, we
connect
can
on
take
the
the
questions?
question.
Okay.
Ma'am, what you talked about is that stepped up price from the buyer's perspective. I think there are a lot of judgments, they're not allowing on stepped up price, they're allowing the depreciation only on WDV. Can you just highlight on that?
Sure. So it's a good question, hyper technical, but anyway, let me try simplifying it. So basically what he's saying is there is a provision in the law which says that if you've bought something, and so let's say it was worth 100, you bought it for 120, and therefore we're saying the cost step up is a 20, right? So there is a provision in the law which says that if, let's say, the seller has taken depreciation on that asset for 5 years and the life is 10, the buyer should get depreciation on the same price for the balance 5 years. So nobody's better off, right? So but the view that is taken is, again, it's litigative. One will need to kind of evaluate it for every specific fact. But what the argument is made is 120 is what I've paid for it, right? So what you're saying is, again, more relevant, maybe also in a demerger case. Maybe I'll just go to that.
Yeah, I'll just, sorry. Yeah, so in terms of the depreciable asset, yes, that is a challenge. You will not be able to take the step up unless and until, say, for example, building. Okay, if you are, kind of in a position to say, because land is not depreciable, so building, if you can justify to say that, okay, this is, this was the worth of building at that point in time, but when I bought, I paid so much, like maybe 2x, based on the valuation report what I, get it from a third-party valuer. That is possibly, we can still argue to say that, okay, I have paid extra for the business. But if it is, say, pure, say, plant and machinery, it's as good as, you live with that depreciation what was there in the earlier books, you continue for the balance remaining period. The play will be on the intangible assets. If you can identify something out of those 5, intangible assets which are depreciable, that will, kind of give you everything else, in terms of the depreciation, everything will be kind of given to you. But depreciable asset, yeah, it's very difficult to kind of justify that it is more than what the seller has claimed.
Yeah, I think it also comes down to valuation, because typically if you've used, let's say, a plant and machinery for 3-4 years, the value will not largely be more than what you've recorded in the books, right? So like he said, it'll be more in terms of building, intangibles and things like this. Yeah, but then you'll also have to look at what is GST, what is income tax. So therefore, you'll have to look at the whole scheme of things and not just one point and make that decision.
Yeah, and also in itemized sale, again, you don't know how you will justify for a plant and machinery, you will, paying more.
The issue remains the same.
As compared to slum sale, because that will be same, more or less it will not change.
And in an itemized sale, you can't have any intangible which is not recorded in the books, right? In case of a slum sale, the seller may not have recorded that intangible, but he's created that intangible and that's why you're paying for it, right? So that becomes the difference. I'm not saying you should not create a goodwill. If you have goodwill, you're not going to get a tax break on it. That's the point. Yeah. So it's not so simple and straightjacketed in that sense. So there are a lot of things, right? So tax is one thing we're dealing with, but like Aditya mentioned in the beginning, there's so much more to the deal, right? You have FEMA, you have financial aspects. So more often than not, tax doesn't become the driver of the deal. It's just one of those things that you will kind of look at. So yeah. So since we were on the topic of demerger, I thought I'll just quickly jump to that and explain why we're saying that cost step up, etc. is more of a challenge in a demerger, because at the heart of it, the idea is that the demerger is tax neutral, right? So it's an NCLT approved approval route that you will take, and the consideration, as you can see here, so while unit 2 is being sold from the seller company to the buyer as a demerger, the consideration goes to the shareholders. So the logic is that the shareholders' value should not reduce in any way, right? That's why you do a swap ratio. So what you do is you will value the business. So let's say unit 2 is worth 100. You will value the shares of the seller and the buyer, arrive at a swap ratio and ensure that the shareholders are made good that 100 in the buyer company. So therefore, this is treated to be tax neutral because nobody's really gaining anything in terms of valuation here. And therefore, the cost remains the same. If you're following Ind AS, you're under common control, then you'll do your pooling of interest method, etc. So,
We have time till 4.
So maybe, since there's a lot of interest on slum sale, I'll just take you through some case studies. So here we have a case where every fixed asset, liability, current asset, everything has been valued. And you've come to an aggregate number of 72 crores and you're transferring a business, okay? So the question is it really a slum sale or an itemized sale? Yeah, so now you kind of got it, right? So one is, it's a business. Second, it needs to be for a lump sum consideration. Yeah. So this is while you've very quickly said it's itemized sale, it's a matter of lot of litigation. It's not as simple as that in a practical scenario. So there's tons of litigation on this.
Just one question relating to this. What if I, in a agreement, I do the agreement, I identify all the assets and liabilities, and I sell it at 72 crores? Will it be considered as slump sale or an asset sale? Yeah. So most of the time, what happens is, though we say that you should not, kind of individually allocate the numbers to the assets, but the transaction cannot happen without identifying the assets and liabilities. So the question sometimes arises like, if I just put down the assets and liabilities in the agreement without valuing those assets, will I kind of dilute the slump sale concept itself? The answer is no. You can definitely very well, you can identify the assets and liabilities, but don't allocate the value to the individual assets and liabilities.
So even in a business transfer agreement, typically you will state that, for example, if I have an immovable property, for stamp duty purposes, I'm valuing, let's say, a land separately. It will still be a slum sale and I'm doing this only for the purpose of stamp duty. So that's a little bit on that.
Possible, because the business definition says business or part of the business.
An undertaking.
Yeah.
So this is a little more trickier. So this is a scenario, and happens very often, where there is a global transaction. So let's say in our case, there's a transaction at a US level, pursuant to which you have two Indian entities, one of the seller and one of the buyer, and you're doing a slum sale here, right? Now the question is, can I do this slum sale at an India level, for example, at book value, right? Because end of the day, it is happening all in India, so do I really need to be bothered about the value at which I'll do it, right? Because from a Indian exchequer tax perspective, it's just moving within India, right? So the tax authorities are not really at a loss in that sense. So we have something under transfer pricing called deemed international transaction, okay? So simply put, what it says is, if you're doing a transaction in India, which is influenced by your related party, okay, while the transaction is with a third party, there is a sense of influence that is being put by your associated enterprise, then we will call it a deemed international transaction. So why this is important is, one is you have 11 UAE, which gives you the value at which you need to do it. But there is a school of thought that 11 UAE is there as valuation, but need not necessarily be the arm's length price, right? Because under transfer pricing, what is important is the arm's length price. So therefore, we just thought we'll bring this out. So, so theoretically speaking, you will not be able to really do this at book value if it is a deemed international transaction. And that is an analysis in itself, so I wouldn't really want to get into too much on that. So you will have to first evaluate whether it's DIT and then look at whether you can do it at book value or not. It's possible to do it if it is not DIT.
Yeah,
Anything to add?
yeah, just one more thing is, if it is an international or global transaction, it is better to highlight the whoever is the party outside India, that India valuation has to be done, because most of the time what happens is it is a just one value, right? When you are selling a global business, it's just say $100 million. We don't know how much is attributable to India. Maybe India is more than 100 million, but when you consolidate, it becomes less than, I mean, the consolidated value becomes 100 million. So it is very, very important to highlight because of this, because because of the deemed international transaction, it is better to highlight, to say that, okay, there is this provision, you need to take into account the India valuation when you are considering the global transaction, because the Indian transfer pricing authorities are expected or expecting you to do the transaction at a fair value, right?
And just to add, in a lot of cases in these scenarios, what we see is the Indian business transfer agreement draws reference to the global one. So that is something which is a strict no, because you don't want to, I mean, this definitely will be picked up for assessment, right? So you don't want the income tax authorities really getting hand of your global transaction documents, etc. So even if it is driven by a global deal, we always structure the documentation in such a way that it's an independent slump sale happening at an India level. There's a lot of things. For example, is the Indian slum sale, while it is based out of a global deal, who's calling the shots, right? So who's determining the valuation, for example? So if it's the Indian board who's doing it separately, they are doing everything in relation to the transaction, then you may be better off. Sometimes what happens, and the tax authorities, as you know, are also getting more and more smart, right? So we had a situation where it was just like they bombarded the social media saying that they're doing this deal. Now to say that this transaction has got nothing to do with the global deal, that was more optics rather than anything to do with tax. So then they took a view that we'll not do it at book value.
I think today the assumption that detection risk is low is completely wrong. I mean, they will detect, or somewhere it will come out, because if not anything, they'll ask you like, okay, it has been sold worldwide. Then you have to either say yes or no. So yeah, so take an example where correct. So example, there is a 1,000 crore deal happening globally. Buyer, seller, everyone is outside India, and in India they sell this one small business from the seller to the buyer, right? Now I have an option to do it at a book value, because it is India level. I have a valuation guideline given. I will do it and I will keep quiet. But why I have done this is because that worldwide transaction, right? Those guys have paid 1,000 crores. Whereas actually if you do the valuation, maybe the value of India business is at 200 crores. But I do the transaction at India level, I do it at hardly maybe 10 net worth value, right? If that is the case, then they can always say that you have to do this at a 200 crores and not at a, say, net asset value.
Under transfer pricing, they'll say this is not an arm's length transaction and impute a value. So they can ask you, they can say that we'll do a DCF, use any other method that they want and impute a value and expect you to
and
pay
we've
tax
seen
on
the
that.
time gap also. The global transaction would have happened in, say, Jan. The India leg will happen maybe September. There's a proper 6-7 months gap. Still, it is better to have that at a fair value rather than at a book value, if it is international transaction.
So sorry, just one more point to cover. So the other scenario where we've seen book value slum sales being evaluated is where, let's say the buyer does not have an Indian entity, okay? And the seller would set up an Indian entity, do a transfer, and those shares are then sold to the buyer. So they're looking at doing the slum sale at book value, but the share transfer at fair value. So that clearly is a big red flag. Yeah. Sorry, you had
consideration gets gets transferred from it's transferred between two US entity. The consideration ideally doesn't flow down to India.
Absolutely.
And then the seller company, the parent company transfers the amount to the seller company. Is that okay, or
No, because then FEMA will not allow them to get the money inside, because on what basis they will take it here?
okay?
Yeah. So typically, what we have seen is that it will remain at the US level. The India leg will be at a nominal value.
Right.
You know, the exchange will happen at a nominal value because the value would have been done there. But we are not comfortable with that. We are saying you do this at a fair value at India level. Say, it's the same example, your 200 crores gets exchanged here, 800 crores gets exchanged in the US level. Though it's not tax efficient, but again, it is, rather than getting caught later, it's better to do it at.
Another question was, assume a weird scenario where India net worth is negative currently, the unit which is.
We have that, I think, yeah.
So yeah, so clearly we've sensed your question. So the next one is on negative net worth. So again, a plethora of judgments on this. So any thoughts? So basically the net worth of the business that you're selling is negative. So mathematically the equation is sale consideration less cost, right? So in our case, let's say the sale consideration is 1 rupee, okay, because it's a negative net worth business. So will you say there is no gain, or will you do 1 minus of minus, so 1 plus 100? What would be the answer? Any guesses? No, I'm saying it's a slump sale. Don't change the facts. So yeah, again here, like I said, it's a very litigative matter. It's currently pending at the Supreme Court, right? I don't think we have a judgment still. So the more conservative view obviously is to add it back to the cost. There was one case law that I found interestingly which said that if your consideration is nil, then don't add anything back. I don't know, doesn't make too much logical sense to me. I mean, so the reason why they say add it back is in a scenario of negative net worth, the idea is the liabilities are more than the assets, right? So the buyer is subsuming your assets. So technically, he is taking over something from you, and you've got a consideration in some sense because you're no longer paying that liability. So if, let's say, standalone, it was a liability in your books and you really didn't have to make good that liability, you would have taken it to your P&L and paid tax, right? So therefore, applying the same logic, the saying in case of a negative net worth also, you add it back to the consideration and pay tax. Again, not really a settled position, but a more conservative view, yeah? So quickly just moving on.
Yeah, I mean, just to add, say, if you are paying in a negative net worth, if you are paying something, then it is clear shot they will add it.
Yeah.
Say for example, 100 crore negative, and you say pay 10 crores. So 10 minus of minus, they will say 110 is your gain. Because first of all, it is a negative net worth. You should not have been paying anything. Okay, so on top of that, you have paid 10 crores. So that will be added. But if it is zero, then it is slightly dicey, like which way, you know, that's the litigative part.
So quickly moving on, so you know, we've done the whole discussion around what is slum sale, itemized sale. So similar question comes up in case of demerger as well. So let's say again you're demerging a unit, everything except the indirect tax liabilities are transferred. So whether this is really tax neutral, because the law says that all properties, all liabilities of the undertaking need to be transferred. So just in the interest of time, maybe I'll just move on with the answer also. So this was actually a practical case that we dealt with. The buyer didn't have an entity in India. They were not really too much pressed on time, so the seller did a demerger. But since, as per the transaction terms between the buyer and seller, the indirect tax liabilities were not to be moved to the buyer. They didn't want to move the indirect tax liabilities as part of the demerger as well. Our view was that it won't be tax neutral. But then the client discussed with a few other advisors and they were okay to take that position and went ahead. But strictly speaking, all assets and liabilities relating to that undertaking need to move in a demerger. Yeah?
Assuming it's not a demerger, so then would we treat this as slum sale or itemized sale?
So it becomes a non-tax neutral demerger. Taxation of that is a subject in itself, because what happens here is uh, the, the buyer is getting the business but not paying anything for it. The shareholder is getting the shares, but it's not given up anything, right? So whom do you tax and how do you tax? Like I said, that's a discussion in itself.
So in all likelihood, all the parties probably will get taxed because when you transfer the business, again because of the valuation, you have to do, like say assuming this is non-tax demerger, it will be considered as a business transfer, right? Now slump sale and the demerger are similar except for the NCLT. Rest everything remains the same. So more likely that will be considered as a slump sale, and they will, since there is no consideration, they will take the deemed value, the 50B value,
50D.
which is which has been prescribed now. So that will be in the hands of the seller, the seller company. Now coming to the person who is receiving the shares, that is the seller company's shareholder, he will be most likely will get taxed under 56(2)(10). That is the receipt of the shares without any consideration. Yeah. It was okay till that amendment came. Now it says it is like 56(2)(10), which says that you have to transfer at this minimum value. If you don't, then there is a tax implication. So same thing has come for the 50B now. There is a minimum prescribed value. So your tax liability may be restricted to that amount rather than the whole business. Yeah.
So in some sense, you're right, because 50D starts off with saying that where consideration accrues or arises. So like I said, we can take a 2-hour session just on that.
This is 50B, not D. I'm talking about, yeah.
Yeah.
For calculating the net worth of the business? No, you can keep it. Yeah, you can keep it. Actually, for the calculation of the net worth, or rather business undertaking, you can keep it. But in a commercial transaction, they will prefer to take it unless it is commercially, agreed that it has to remain. It will go to the buyer. That's what I'm saying. Yeah. To the collateral to the
transferor company.
Ha.
So you want to transfer a land through a demerger. Now it is given as a collateral to the loan, but the loan is not used to acquire the land.
So then, sir, the bankers will not allow.
No, let us say the banker is giving the consent that this charge, so long as the demerged entity also gives the charge, can we retain the charge and continue the charge, or we should remove the charge?
So if you look at the 219AA, where it specifies the conditions, and also it says what liabilities should be transferred, it clearly says all the liabilities pertaining to the business needs to be transferred. So with that, you need to transfer that charge and everything, the loan along with the collateral. Okay. That can be done. Yeah, that is fine.
That's more a legal thing, not really so much on tax.
That should not be a problem. Correct. That should not be an issue. That should not be an issue.
Yeah. So another point on demerger is, in this case, the shares are not being issued by the buyer company, but the shareholder of the buyer company. So the question is this permissible? So again, this is based on interpretation of the definition of resulting company. So if you see what resulting company definition says, it says one or more companies, including a WAS, right, to which the undertaking is transferred, and the resulting company issues shares in consideration. So this is actually practically done. There are multiple rulings, courts have blessed this. So what we're saying is the resulting company definition includes both the company to which the business is being transferred and its parent who's holding 100% shares, because of the way the definition of resulting company reads. So one is getting the business, the other is issuing the shares. Both are resulting companies, and therefore the definition gets met. So this becomes very useful where you don't want to have a cross-holding at an India level, but at an overseas level, you're okay to have that shareholder holding shares in the holdco. So that that's where this gets used. And we have cases like Thomas Cook, Globop, where this has been blessed by the NCLT. How it gets accounted in terms of the whole thing, that's a different ball game altogether, because one is getting the business, the other is issuing the shares. How do you do a double entry accounting? Again, is tricky, doable because people have done it, but yeah.
Yeah, this was done mainly by the startups actually when
Yeah.
they were externalizing the structure. If you guys know, now the world has changed. Now everyone wants to come
Come
to
back
India.
to India.
So how it used to happen is, just in this example itself, shareholders like all these funds and all have a startup in, that is a seller co. If you want to now externalize, when I say externalize the structure, that means the holding, your holding should go out of India. Say, the desired structure when we say externalization is holdco, which is outside India. The shareholders, these shareholders are holding the shares of holdco. That was the structure which was preferred maybe a year, 2 years back. Now the things have changed, but how do you achieve that structure is by demerging the seller co into buyer co. Buyer co is an Indian company, and the shares were issued by the holdco, which is a company which is outside India, say Singapore or US, and the shares were issued to the shareholder. So what happens in this case is, the structure gets, kind of flipped outside India. So the shareholders hold holdco, which is Singapore co, and that Singapore co holds the buyer co, which is in India, and the business comes to buyer co. So, but now everyone wants to kind of inverse, that is like, they want to flip the, collapse the structure.
So merger again very similar to demerger in terms of tax implications, etc. Like Aditya mentioned, not something that is done straightforward in a deal, but this is more done as a next step. So, if you've done a share purchase, you bring the entity into your fold and then you merge it so that you're getting rid of the entity. So tax neutral, any consideration which is paid other than cash gets taxed in the hands of the shareholder. Otherwise, it's tax neutral for all parties involved. No GST implications. So one quick case study here is where the merger is happening overseas. So it's a foreign merger. But so in our facts, company B is merging into company A. But because of the merger, India company shares is moving to company A. So the question is this taxable? So under the Income Tax Act, under Section 47, you have a specific exemption which says that it's not taxable if the shareholder of the merging company, which is company B, continues to hold 25% of the capital of the merged entity. Okay? But in our case, it's a WAS. So company B, when merging into company A can't issue shares to itself, so there is no share issue that is happening. So condition 1 doesn't get satisfied. Second condition is that transfer is not taxable in the other jurisdiction in US. So assuming that is satisfied, the question that came up is such a structure taxable in India? So is there really a transfer of an India company happening? So there are some advanced rulings on this matter, one of it being Hoish, where they've said if there's an impossibility of performance, it's deemed that that condition is satisfied. So where the entities don't really look at doing any transaction in India, but it's more combinations happening overseas, this is something we've commonly seen. Share transfer at the heart of it, very simple to do in terms of just buy the shares. But I'm sure everybody here would agree that it's one of the most complicated things to kind of do and implement. So a lot of things from a tax perspective as well on share transfer. Capital gains is simple, it's sale consideration less cost. But what is the sale consideration, what is the cost? Tons of things to look at. From the buyer's perspective, it has to be done at a minimum value, which is the Rule 11A value. If you don't do it at value, then the buyer gets other income. Unfortunately, there's a similar provision from a seller's perspective. So that becomes the full value of consideration. So therefore, they end up paying more tax. In case of cross-border transactions where you have non-residents involved as buyers or sellers, then you will also have to look at the treaty. So if let's say the seller is in Netherlands, like Aditya said, Indian company shares are being transferred from Netherlands, let's say to US, then it's not taxable in India. If Netherlands is selling into India, then it becomes taxable in India. So, and as per the Income Tax Act, you look at the local law, the treaty, whichever is more beneficial, right? So that is an important point to look at. Another thing, important thing that comes into play in case of share transfers, like Aditya mentioned, is whether losses continue, right? Because under Section 79, if you are a closely held company and your beneficial owner beyond 49% moves, then you lose the losses. Startups have some exemptions without really getting into that. So this becomes important again when you're doing a due diligence from a tax perspective to see whether there are losses, how much is that, what would be the impact, etc. This doesn't impact unabsorbed depreciation, it only impacts business losses. 281 and 81 would continue to apply, but in case of a slum sale, it is the seller entity. In case of a share transfer, it is the sellers of those shares, right? So that's the difference. So there are TDS and TCS implications here as well that one will need to kind of look at. So just mulling a little bit on accumulated losses. Okay, so two scenarios. C company has losses, it's based in India. Scenario one, we have the Indian company's shares being transferred. Scenario two, we have the transfer happening at one level above the Indian company, right? So in which case do you think the losses would lapse? So like I said, the beneficial ownership beyond 49% has changed, then you lose the losses. So where it's a direct transfer, do you say that B company is not the beneficial owner? So let's say it's 100% through the chain. So do you say that A company is actually the ultimate beneficial owner? So in our case, A continues to hold in D and therefore in C. So do you say losses don't lapse? Or do you just look at the immediate shareholding and say that it's no longer held by B and therefore it should lapse? So any guesses? Sorry? No, so the losses are in C. So C has to use those losses, not the shareholder. Sorry? Yeah, so again, anything in tax in India is not simple. So there are negative rulings on both sides. So in one case, like in scenario one, the ultimate shareholder remained the same. So they ruled that the losses will remain. But I think our view is that in scenario one, you will not get the losses because your immediate shareholder has changed. Now, while we're on losses, but if let's say there are non-residents involved and you actually go to a point to say that B company is not the beneficial owner of those shares, if in any event you need to take a treaty benefit, then it gets very, very complicated because the treaty says that whoever is the beneficial owner gets the benefit. In a different case, dividends and capital gains and things like that. So do you really just pierce a corporate veil? The answer would be, it's not as simple as that. Yeah. Okay, this is the last topic from our end, indirect transfer. So I thought it was fitting that, since Aditya started with the Vodafone case, I end with it as well. So like most of you know, indirect transfer is basically where the immediate shareholder of the Indian company doesn't change, but the transfer is happening levels above it, right? So in our case, we have the shares of a Singapore company being transferred from Netherlands to UK. Okay, so when does it trigger an indirect transfer tax? If the shares of company E get substantial value from company F, which is in India, right? So what is substantial value? It is basically where the value of assets in India exceeds 10 crores and the value is 50% or more of the overall value, right? And you look at this on a specified date. Now what is specified date? It's either the end date of your last accounting period or the date of transfer if the book value of the foreign company's assets is exceeded by more than 15%. Sounds very, very simple, right? So scenario one, if you can tell me based on what we just heard, Date of transaction, November 30th, okay? March 31st, 2024, therefore, is our last accounting period. For overall value, 100, 50, so while I say company E, I mean the overall value, okay? So consolidated value of company E is 100, sorry. Company F, 51. So if I were to stop there, substantial value? Yes. Value is on November 30th, 150. So more than 15%. Company F, I will see more than 50%, so you're home. Let's add a little bit of complication to this now. So value as on March 31st of the overall group is 100. It reduced to 80. So which date would I see? These are all practical examples. We've dealt with it. So the question that comes up is, do you read exceeds as reduces also? Right now, obviously you can't put words where they don't exist. So there is no settled position on it, but the better view is that you will go with March 31st, okay? So we had another case, just wrapping up quickly, we had another case where overseas entity, so let's say US holds Netherlands, Netherlands holds India. Before the share transfer of the Netherlands entity, we were transferring the shares of the Indian company, okay? So as of the last date of the accounting year, you have US, Netherlands, India. But when you're transferring shares of Netherlands, India doesn't exist below it. So where do you see this whole indirect transfer provision was the question. We took a view that, you know, since the Indian shares don't even exist when Netherlands shares are being transferred, we should be okay, but we are also still awaiting to see how the tax authorities would kind of view it. Yeah. Sorry? It was more an internal restructuring, not a deal. So therefore it was easier to deal with, but yeah. So yeah, so this is what we had today. Any questions? I think bang on time. Sorry, I had to rush through a few things, but we wanted to ensure we end on time.
So we do have a Q&A in the next session. So
Yeah.
it will be a panel discussion. Primarily, you know, we've heard so much, but when all the three experts sit together, right, the banker, the diligence, and the tax expert, a lot of brainstorming gets done as to what they do, how they do it, how they advise their clients. At times, they are very controversial. Like a thing that benefit interest of a banker will never be in the interest of a diligence guy. Diligence guy loves deal breakers, and a banker loves deal makers. And the tax guys are the ones who are trying to stitch through between both of these. That I see deal breakers, I see deal makers. How do I make sure my client is happy with our advice, right? We'll have a good amount of brainstorming on that as part of the panel discussion. So if you have any questions on your mind, please feel free to, you know, add. I'll try to moderate it as balanced as possible to cover all the three subjects. But if you have any questions, so just come prepared and please participate. And we look forward to everybody moving to the little break in the next session. It will be more enjoyable for everyone.
We'll break for tea and reassemble in 4:15 for the next session. Thank you.
Of charter runs.